Hey everybody, it's Bruce here with Stock Markets with Bruce. How you doing today? Welcome to my channel. Today's video is all about stock buybacks. There are a lot of companies out there buying back their shares, and the question is, why would they do that? What is the point of it all? And how does it work? And let me give you a quick little kind of recap here. Companies go public to raise money by selling shares in their corporations. You might have, say, Apple, founded by Steve Jobs and Wozniak, going public in 1980, for example, at $22 a share. They raised $100 and some odd million when they did this, and this gave them enough cash to start building out their factory to start producing more computers. Increase their distribution system, increase their research, all of this stuff. Well, over the years, companies like Apple and others would raise cash in additional share offerings, perhaps to investment funds, mutual funds, that type of thing. And they would raise cash as their shares rose in value and their prospects got better. And they would then either take over their competitors or they would create new factories. In the case of for example, Tesla, they went public at $17 a share, raised a bunch of dough, then they issued stock again and again and again at prices going up to raise even additional cash. And Tesla has now been able to build a mega gigafactory in Nevada. They've built a factory now in China, and they've made other partnerships and they've taken on acquisitions. After a certain point in time, though, certain companies reach a certain level where they don't need to raise cash anymore. Their sales are maturing out, their margins are healthy, and they have more cash piling up in the bank than the year before, and they don't need to sell stock anymore. And it then gets to the point after a number of years, they decide that their shares are undervalued. And some companies feel that if their shares are undervalued, they might be a takeover target. They don't want to be taken out by a hostile bidder, for example, or a group of outside investors come in, activist investors. You might have heard of that term. And these groups of investors are saying to their followers, hey, we think that the company so-and-so is trading well under its value. We think we should buy up some of the stock and shake up the board of directors, and maybe we'll create a scenario where we can get this company taken over by somebody else. Well, management of companies are always watching out for themselves, of course, in their careers. And one way to stave off being bought out is to reduce the number of loose shares trading on the street. And one way to do that is to have a corporation buy its own shares back on the open market. And when the shares are acquired, they are then canceled out of the treasury of the company. And every year, the number of shares outstanding drops. The earnings per share goes higher because you're dividing the earnings made by the company into fewer number of shares that exist, and the company's shares earn more per share. And with a PE multiple of 10, 20, 30, 40, 50, whatever the PE multiple is, the shares trade at a higher value. The higher the value of the stock on the open market, the less likely of a takeover target the company becomes, and management's jobs are saved and spared. They're not going to be taken over by somebody else and then fired. Apple, here's Steve Jobs. This company went public in 1980. They raised money in the 80s and in the 90s to build up their balance sheets, and then in the 2000s, they started making a lot of profits. The company, after a while in 2012, had 6.6 billion shares outstanding in total. And the shares were trading at less than $100 a piece. And there were people out there saying, gosh, for a company that makes this kind of cash, their shares are undervalued. And the management have got to do something to get the share price up. Well, every year, it just wasn't good enough for investors that Apple would build up its cash reserves. And to the point in time in the early 2000s, Apple was approaching 60, 70 billion cash on hand. Apple didn't need to buy any competitors per se. Any competitors they bought or any companies they bought were much smaller than Apple was, and they would use $1 billion here, $500 million there, $2 billion here to buy up companies and bolster their product line. But in 2007, when they brought out the iPhone, And thereafter, the company's prospects were phenomenal, and they really started building up cash. So in 2012, they decided they were going to do a stock buyback program to reduce the number of shares outstanding. And in 8 years, from 2012 to 2020, they have bought back 2.3 billion shares, and they have spent over $385 billion to do it. Even with all that, the company still has over $200 billion cash in its bank account, and its overall value is now roughly $1.5 trillion. These numbers are just outstanding to think about. They're just wild. While Apple has been successful in doing share buybacks, its shares have now reached $370 a share, so every shareholder in the company is sitting on stock at record high prices. The company still only trades, if you take a look at this chart right here, it's only trading at about 28.6 times earnings. And that is not an exaggerated stock price, even in around this $364 price that you see here on this chart. As each year goes by, they will continue to buy up more stock. They've got all of this cash. No one's going to take them over. They're too big to be taken over. But they don't need 200 plus billion in cash to fund their operations. They're continually adding to the bottom line. And so they'll just keep buying up their stock, and their shares will keep rising in price, because at 28 times earnings, every dollar a share they earn is $28 a share higher they'll trade at on the open market. But of course, if they reduce their stock by another 10%, that might pop the market another $30, $40 a share. So this stock could be $400, $450 the next year or two, just because they're buying back a bunch of their shares and constantly earning more money every year. Like I said earlier, other companies are trying to do this. IBM, Home Depot, even the airlines, they were all buying back their stock. General Motors has been buying back their stock prior to going bankrupt. Sometimes companies spend too much money buying back their stock. There's too much pressure on the management of the company to buy up shares, and it backfires on them. They don't have enough cash when they really need it for a downturn. Right now, the airlines are really regretting spending billions of their cash over the last 8 years buying up their stock, when today very few people are taking airplane rides, and these airlines shares have dropped by 60-70% in price, and now they're seeking bailout money from governments. In Apple's case, they're not going to need a bailout from anyone with $200 billion plus cash on hand and a reduction of their shares. They've got the best of both worlds. But you can see how stock buybacks work. It can be a defensive mechanism to stop a takeover from someone else. It commits the company to using its cash to buy up shares, and it makes it less attractive for someone else to want to take them out. But it makes the stock more attractive because there are fewer shares outstanding and earnings get divided into fewer shares. So there's a couple of reasons why companies use share buybacks. Some people love it, some people don't. But there, I hope, is an explanation that you can understand on how share buybacks work, why corporations use them, and in some cases it works very well, in other cases not always. Thanks for joining me today. Hope you enjoyed the video. Give it a thumbs up if you like it. Subscribe to the channel. And we'll talk to you later, everybody. Bye for now.